Navitas Semiconductor closed its last trading session on Friday, June 5th, 2026 at exactly £25.08 per share, marking a massive single-day plunge of 18.23% as the market closed for the weekend. This dramatic drop cut through a massive multi-month rally, wiping out a significant chunk of value in a matter of hours as more than 36 million shares changed hands. While a sell-off of this magnitude would normally suggest a fatal flaw in a company's fundamentals, the reality under the surface tells a completely different story. Just days before this macro-driven collapse, the stock had surged over 19% to trade near its 52-week high of £34.17 because of an official showcase alongside microchip giant NVIDIA at Computex 2026. The contrast between this sudden operational validation and the brutal market sell-off creates a fascinating setup for individual investors. If you are tracking high-growth tech names on platforms like Robinhood or checking your holdings on the Interactive Brokers platform, this sudden divergence between structural progress and equity pricing is exactly the kind of volatility that demands a closer look. The common narrative surrounding Navitas Semiconductor is that it is a high-flying speculative play riding completely on the coattails of the broader artificial intelligence hardware boom. Mainstream market commentary often paints it as a volatile asset that moves purely on retail hype, easily shaken by macroeconomic shifts. The prevailing expectation was that as long as the broader tech sector kept climbing, small-cap component suppliers would drift upward alongside giants like NVIDIA stock, Apple stock, or Tesla stock. However, Friday's aggressive downswing proved that expectation wrong. The broader market experienced an intense sell-off triggered by a surprisingly hot jobs report from the Bureau of Labor Statistics, raising immediate fears that the Federal Reserve might implement further interest rate hikes to combat stubborn inflation. For a high-growth, capital-intensive business that is not yet net profitable, the threat of higher interest rates acted as an immediate detractor, causing institutional algorithms to dump shares indiscriminately. But looking at the tape, this massive drop occurred on the heels of major corporate milestones, including the issuance of over 3.2 million shares tied to merger-triggered targets, meaning early institutional backers are hitting their operational marks, even if the macroeconomic climate is throwing a temporary tantrum. When you look at current trading volumes and market mechanics, Navitas is experiencing a classic tug-of-war between short-term macro anxiety and long-term industrial positioning. Long-term investors utilizing self-investing strategies or managed options like Schwab Intelligent Portfolios are forced to weigh these volatile daily swings against structural realities. While the stock has pulled back sharply from its recent highs, it is vital to remember that it entered this week up more than 330% since the start of the year, driven by intense institutional accumulation. Wall Street analysts maintain highly divided views on the company, with some sticking to conservative models that suggest a fair value closer to historical baselines, while others recognize the accelerating demand for high-efficiency power infrastructure. This divergence is exactly why active traders on sophisticated online investing systems look at names like Navitas. The extreme options pricing and heightened volatility mean that any sudden shift in sector momentum can cause massive price swings, making it a critical asset to study for anyone managing an individual brokerage account. To truly understand why the market is reacting so violently to Navitas, we need to examine what happened at Computex in Taipei. The company was explicitly featured during an industry ecosystem showcase, specifically highlighting an 800-volt to 6-volt direct current power delivery board. This specific hardware utilizes the company's proprietary GaN-fast gallium nitride technology to achieve a peak efficiency of 97.5% while operating at high switching frequencies. In plain terms, as artificial intelligence data centers scale up to megawatt levels to process complex large language models, power consumption and heat generation become massive physical bottlenecks. Traditional silicon-based power regulators simply cannot handle the sheer electrical load without melting or wasting massive amounts of energy. By positioning their thinner, highly efficient gallium nitride and silicon carbide chips right next to power-hungry graphics processing units, Navitas is solving a critical physical limitation of modern computing. This is why the underlying business is seeing its addressable market projections scale towards billions of dollars by the end of the decade, even as the stock price suffers from short-term interest rate panics. Let us transition into how you should view this from a practical portfolio perspective. If you manage your personal financial assets through Fidelity Investments, looking into specialized technology vehicles like Fidelity ETFs or allocating capital within a Fidelity brokerage account requires balancing secular growth trends against intense execution risks. Navitas reported its first quarter financial results a few weeks back, delivering revenue of $8.5 million, which actually beat conservative consensus estimates by roughly 5%. However, its earnings per share came in at a loss of 15 pence, missing expectations due to heavy spending on research, development, and scaling out production capacity. The market initially looked past the net loss because the company's high-power infrastructure segment grew by 50% sequentially, proving that they are successfully shifting away from low-margin consumer electronics components and moving directly into premium enterprise data center hardware. This structural pivot is precisely what caught the attention of large institutional growth funds, but it also leaves the stock exposed to massive downside whenever the macroeconomic narrative turns sour. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, or if you prefer sticking to larger, profitable semiconductor giants instead. It is always interesting to see how retail capital allocates between speculative component plays and established sector leaders. To build a complete view of Navitas, we have to look back at how the company got to this position. Founded in 2014 and operating out of Torrance, California, the company went public via a special-purpose acquisition company merger a few years back. Historically, their primary business model revolved around supplying gallium nitride chips for fast-charging bricks used in mobile smartphones and laptops. If you have purchased a compact high-wattage wall charger recently, there is a very high probability it contains their technology. While that consumer market provided initial revenue and allowed the company to validate its manufacturing processes at scale, it is inherently a low-margin, highly cyclical business. Recognizing this limitation, management began allocating significant capital towards high-voltage silicon carbide technologies, completing strategic acquisitions to build out their asset portfolio. This older strategy laid the structural groundwork for their current enterprise products. By transitioning their expertise from small smartphone chargers to massive industrial power supplies and electric vehicle drivetrains, they managed to position themselves as a necessary infrastructure provider right as the data center build-out began accelerating. Looking at the financial health of the business through a standard individual brokerage lens, the balance sheet presents a classic high-growth profile. According to public filings easily accessible on popular investing sites, the company has historically carried a negative price-to-earnings ratio due to its sustained net losses. Operating cash flows have remained negative as the firm reinvests every single dollar of incoming revenue back into product development and foundry partnerships. For conservative investors tracking steady metrics via standard Fidelity mutual funds or wealth management platforms, this lack of time profitability can be an immediate deal-breaker. However, for aggressive traders utilizing the Robinhood app or mobile platforms to capture rapid momentum swings, the lack of current net income is often viewed as secondary to top-line revenue expansion and margin improvement. The company recently satisfied significant share issuance obligations under its initial business combination agreements, which does cause short-term equity dilution, but simultaneously removes long-term regulatory overhangs that had previously capped institutional interest. The common narrative surrounding Navitas is that the global data center transition faces severe energy grid constraints, forcing operators to seek out specialized power management components. If Navitas can turn its current technological leads into long-term commercial contracts with major server manufacturers, the underlying reality will easily exceed the conservative financial models currently applied by traditional Wall Street analysts. On the flip side, if macroeconomic pressures force cloud service providers to slow down their capital expenditures, or if larger established chip legacy giants develop competing gallium nitride architectures, Navitas could see its margins compressed before it ever reaches sustained net profitability. This creates a high-stakes environment where any single corporate press release or quarterly update can result in massive double-digit percentage movements in the stock price. When we evaluate the future outlook and potential catalysts for the remainder of the year, several distinct factors come into play. The upcoming second quarter earnings release, estimated to occur in early August, will be a major test for the company's financial narrative. Analysts are expecting a net loss of roughly 5 pence per share, and any variation from that figure will drive intense trading activity across major retail brokerages like SoFi Invest or Interactive Brokers trading accounts. Beyond pure earnings metrics, the key operational indicators to watch will be the formal ramp-up of their high-voltage silicon carbide modules designed for solid-state transformers and industrial power systems. If the company can announce formal purchase orders or deeper integrations within the hardware specifications of leading server infrastructure designs, it will provide a massive structural cushion against the broader macro anxieties that dragged the equity down this week. Ultimately, the massive drop we witnessed to end the week highlights the structural friction of investing in early-stage technology infrastructure.
The prevailing market expectations shifted instantly from unbridled optimism over a prestigious technology showcase to intense fear regarding central bank policy and macroeconomic liquidity. The reality is that Navitas Semiconductor remains a highly specialized, technically sound business that is successfully moving into the most lucrative subsectors of the chip industry, but it is doing so while remaining completely exposed to the capital constraints and systemic risks of a pre-profit enterprise. For individual investors utilizing digital platforms, whether through active trading on a Robinhood stock trading account or managing broader risk profiles through comprehensive online investment strategies, navigating this specific asset requires a clear understanding of that structural disconnect. The recent volatility has laid bare the stark contrast between short-term equity pricing and long-term operational execution, setting up a compelling environment as the industry awaits the next round of hard financial data.